Imagine investing 10,000 in just three companies back in March of 2009, turning 30,000 into $1 million. Yeah, it is possible. And locking them away. And then doing absolutely nothing and waking up to see your $30,000 investment worth nearly $1 million. This is reality. These are exactly what the money managers, hedge fund managers of Nomad Partners did, but they did it on a larger scale. Nomad Partners is a real investment partnership based in the UK. And then today, I'm going to walk you through exactly the precise stocks, the exact numbers, and most importantly, the lessons that you can learn and apply today. Bear in mind, the proverbial, the past performance is not indicative of future performance. It's not investment advice for anyone. I'm just relating a story and the lessons that can be learned. As an ex-hedge fund manager, I'm always trying to learn how to make myself better. So let's get started. I want to share with you this, okay? Welcome back to the channel. I'm Andrew Abraham, ex-hedge fund manager, and I want to share my lessons that have worked and not worked. So if you're serious about long-term wealth building, today's video will show you one of the simplest, most powerful examples of compounding money long-term that you're ever going to see, okay? So let's set the scene. If you remember, March of 2009, it was ugly, really bad. To understand this strategy, you have to go back to March of 2009. Put yourself into this. This is the bottom of the great financial crisis. I mean, people thought we were going to be in a depression. It was really scary. People were terrified. Banks were collapsing. Lehman Brothers, markets crashed. Unemployment hit record numbers. People lost their houses. Most investors were selling. But a handful of disciplined investors, smart investors I call them, quietly were buying up shares in, just the example, three world-class businesses during this bloodbath. Voila, now comes the good stuff. What are the companies that they did this? And it weren't AI or magic or anything. You know these companies. Amazon, Berkshire Hathaway, Costco. Because they believed, the guys from Nomad Partners, these money managers, that people are always going to buy at Costco and they're still going to buy on the internet. So these guys from Nomad Partners, they didn't try to guess the bottom. They wanted to buy quality businesses. And they understood something that the majority of the people miss. Great businesses become generational opportunities during market fear and market crises. You have to have the courage to step up to the plate. And you're not going to catch a bottom. You can, the prices can even fall more. But you're buying pieces of great companies that have deep moats. You can't just go build an Amazon. You can't go and knock off Berkshire Hathaway or Costco. So let's start with Amazon, the biggest winner. In March of 2009, Amazon was trading at $3.67 a share. Think about that. That's cheaper than a cup of coffee today. I mean, it's mind-boggling. So put it into perspective. People thought that Amazon was going to go out of business, that online shopping is going to fail. They had no idea about AWS and the cloud and how dominant Amazon could be. I mean, anywhere you are in Europe, you can order Amazon. You're in Germany, Portugal, France, you name it, America, they're all over the place. So the guys from Nomad Partners, they realized this and they stepped up to the plate. And it's a hypothetical 10,000. They did millions. They didn't do 10,000. And roughly, just keep it to simple terms, if you bought $10,000 worth of stock of Amazon, you would have gotten 2,724 shares. You can check me. Just go to any, FinViz or any of these. Fast forward to today, Thanksgiving today. The market's not open. These shares are worth about $229. So your $10,000 investment went to $624,000. That's 62 times your money. Can it happen again? Who knows? Probably not, but you never know. It didn't happen overnight. There were drops. There were crashes. There were corrections. I mean, Amazon at points lost 20%, then 30%, and then I think it was in 2022, 40%. Multiple times these losses. Could you have sat tight? Ask yourself this. This is what long-term investors do, like Warren Buffett and Charlie Munger. They buy great companies and never really sell them. They bought a business. They bought a piece of a business they believed in. And you got to think about it. I mean, who wouldn't believe in Amazon or Berkshire Hathaway or Costco? I mean, it's just... So let's talk about the next one. Berkshire Hathaway. Okay, this is Warren Buffett's company. Unlike Amazon, Berkshire wasn't this, knock it out of the park kind of company. It was stable, diversified, cash generating, everything from candies to insurance, you name it. And it was run by one of the greatest investors in the world. I mean, the proverbial point is you always want to surround yourself with the smartest people. Okay, so now in March of 2009, just as an example, Berkshire traded at $56.40. Invested $10,000, doing the math, 177 shares. Okay, doesn't sound like that much. Today, what are those shares worth? Okay, 90,600. So you 9 times your money. Pretty cool, super cool. Not as explosive as Amazon, but a reliable compounder, high quality business, compounds year after year, and most likely has the propensity to do so. But who knows? So what is the lesson? Buffett's lesson has always been the same. And buy a wonderful company. It's far better to buy a wonderful company at a fair price than a cheap company. So in 2009, all the world was panicking and companies were being sold at bargain prices. Smart investors stepped up to the plate. The next one, Costco. It wasn't just Nomad Partners. Charlie Munger was a major believer in Costco. It's one of the most quietly powerful businesses on earth. They have stores all over the world, not just in America, and their concept is 14% over cost. That's all they charge. And they have the membership. So in 2009, Costco is trading at $32.53. Most investors ignored it. They ignored everything. They were freaking out. So understanding Costco's business model was something that just any smart investor would realize. There's a recurring membership income, a reliable customer loyalty. And the thing is, they had massive, massive buying power, which they shared with their customers. And they have a moat that you can't just open a Costco today. And people are addicted to it. I can name one. My wife. I mean, loves going to Costco, loves saving the money. So let's play the numbers again. Putting $10,000 into Costco in March of 2009, you're going to have, doing the math, 307 shares. Today, Costco is dancing around $900 a share. So that investment is worth $279,400. You know what that means? It's 28 times your money. Not from an AI company, not from NVIDIA or Palantir that not that many people really understand everything they do. It was a consumer company that you just get in your car and you can drive there and see the lives. Consistent, relentless execution of giving value to people. That's how they survive. This is why Costco is loved by long-term investors. Charlie Munger called it one of the most admirable companies on the earth. So wouldn't you think when it goes on sale, you might want to pick up some shares? That's the idea. That's what smart investors do. So let's put into effect the total result. Let's put in the 3 shares. Okay, just 3. And you did nothing for 16 years. 30,000 total. 10K into Amazon, 10K into Berkshire, 10K into Costco. Let me tell you what they're worth again today. I'm going to repeat myself. Amazon, 624,000. Berkshire, 90,600. Costco, 279,400. Adding them up, almost $1 million. $994,000 from a simple $30,000 investment. No trading, nothing complicated, no derivatives, no day trading, no options, no jumping in the market, jumping out the market, being committed, understanding that you really want to own these companies long term. You want to basically buy a great business and do nothing. That's how money is made. And this is reality. It isn't hype that I'm making this story up. You can check all this out. Go to the internet and type in Nomad Partners UK and see what they did. And the only reason it worked, and it's three reasons, it worked so incredibly well. They concentrated their bets into excellent companies. They didn't buy 50 companies or 50 stocks. They bought the best of the best in their interpretation. They bought three world-class companies. With concentration comes volatility. As I said, there were drawdowns. They were 20%, 30%, 40%. But they also had the big rewards. They had the courage to hold through fear. Sometimes buy right and just do nothing is the greatest, way to make money. So over 16 years, to repeat, it wasn't magic. These three stocks had multiple downturns. Amazon lost more than 30% numerous times. And the thing is, most investors would have sold. They would have freaked out. But you know what smart investors do? When there's a drawdown, they might even buy more shares. I mean, they let time work for them. So smart investors held. The power of time enabled the compounding. And compounding is not linear. The big gains come at the end, like a snowball. It just rolls. A 62-time return on Amazon doesn't come from one good year. It's the combination, profit on top of profit on top of profit. Or, just to say another way, is consistent revenue growth, expanding moats, and long-term secular trends. So why is long-term focus beat short-term noise? First of all, it's less pressure on you, and you can do your job, and you can compound money. So really, what do you learn? These are what my 5 takeaways, even though they might not happen in the future, okay? Volatility is the cost of admission. You're going to have drawdowns. You're not going to buy the bottom. Forget about that. If you really want to have long-term big returns, you have to stay invested during scary times and even allocate more, but only into quality businesses. Great companies, not cheap companies, not companies that you don't even know what the heck they do. Companies you understand. It's not that complicated to understand Amazon. All the time I'm ordering stuff on Amazon. It's not that complicated to understand Costco. Not that to understand Berkshire with Dairy Queen and everything else. I mean, there's simple ideas and quality businesses from 2009. The other key point is to hold for at least a decade. And you know what? There might be times nothing happens for years. And they might look boring. And then all of a sudden, when you least expect it, boom, they just jump. So the other key point, don't try to predict the market. Smart investors don't guess the exact bottom. They bought great companies when there was fear. The Rothschilds did this. Buy when there's fear on the streets or blood is flowing. Keep it simple. Keep it with companies that you understand. And if you don't understand companies, you might just buy an index fund. You can really have done pretty well also just buying an index fund. So, repetition. 3 stocks, $30,000, $1 million. There's beauty in not overcomplicating things. The KISS principle. Keep it simple and stupid. So, if you found this video helpful, obviously subscribe and tell me in the comments, and I'll try to answer them and direct you. And I'll ask you, what 3 stocks do you think you can hold for the next 16 years or longer? And I can make a video on these companies, like the same as I said about potential on Amazon, Berkshire, and Costco. And I also want to say thank you for watching, and I'll see you in the next video. And if I can help, that's really my goal, is to help. Thanks.